Good morning. My name's Paul Mickle, Managing Partner of GFM Wealth Advisory. A very warm welcome to our GFM clients and GFM guests joining us on this morning's webinar. An update on one of our favourite listed investment companies, WAM Microcap, listed on the ASX under the stock ticker WMI. We're absolutely thrilled to have Oscar Oberg, the lead portfolio manager of several of the Wilson Asset listed investment companies, and Tobias Yao, who is a portfolio manager at Wilson Asset Management, joining us on the webinar this morning. Now, we actually had Oscar and Tobias present to our clients via a webinar last year, and that webinar was particularly well received. I'm sure everybody will enjoy today's webinar. I'll officially introduce Oscar and Tobias in a moment. It's hard to believe we're already in February 2022. This is our first webinar for 2022, and due to the popularity of these webinars, which we find is a very good way to keep our clients updated on our preferred investments, we've got several of these webinars planned throughout the year. We're very grateful. We're genuinely appreciative of the support and the feedback, the positive feedback we get after these webinars, which inspires us to continue to do these. It's definitely been a volatile start to 2022, both on the COVID front and in investment markets. We hope you've navigated this period well. We hope you're healthy, and it appears as though things are gradually improving on the COVID front at the start of 2022. We keep our fingers crossed this will continue, and we really are looking forward to seeing our clients face to face, something we've terribly missed over the last couple of years. As our clients know, an area that we're a very large advocate of investing on behalf of our clients is in Australian microcaps. We're attracted to investing in microcap stocks to provide our clients access to companies which are growing their earnings strongly, potentially mispriced, and have the potential for lucrative returns. But investing in microcaps requires real skill. I'm sure everybody's been tapped on the shoulder from time to time with the hot stock pick. I think for every dollar I had, if I invested it in these hot stock picks, I probably would be broke. So we are a very strong advocate of investing in microcap, but using skilled managers who have real expertise investing in this part of the market. Now, WAM Microcap is one of our preferred Australian microcap investments. And since it launched in June 2017, WAM Microcap has produced portfolio returns, a stunning result of 24.6% per annum. Now, before we get underway, as we always indicate in these webinars, this webinar is general in nature. It's not specific to you or providing you advice. Certainly, if you've got any questions post the webinar, please contact your advisor and we can answer those questions. Now, let me formally introduce Oscar and Tobias quickly. Oscar has more than 14 years experience in financial markets. Before joining Wilson Asset Management, Oscar worked on the sell side as an analyst at CLSA and 3 years at Grant Thornton working in transaction advisory services. Oscar is the lead portfolio manager and responsible for WAM Capital, WAM Active and WAM Research. He's a busy boy. And then we've got Tobias Yao. Tobias has 13 years experience in the investment industry. Prior to joining Wilson Asset Management, Tobias spent 5 years as an investment analyst at Pengana Capital, and he previously worked at Ernst & Young in the Transactionary Advisors Services division. Tobias is now a portfolio manager for Wilson Asset Management. So a long intro, but good morning, Oscar. Good morning, Tobias.
Thanks, Paul. Thanks, everyone.
We genuinely appreciate you having you supporting us again this year with a webinar. So look, let me get underway with the first question. So look, if you don't mind, could you just give us a quick rundown on the history of Wilson Asset Management, why you launched WAM Microcap nearly 5 years ago in June of 2017, and what you guys see as the benefits of investing in a listed investment company?
And thanks, Paul. Thanks, Patrick, and May and the team at GFM. And obviously, thank you all to your clients for all your support over the years. So look, I'll give a quick overview of Wilson Asset Management and who we are. So we started just over 25 years ago from our founder, Jeff Wilson. We run 8 listed investment companies that trade on the ASX. They have a combined total of around 5 billion of funds under management. Tobias and I look after 4 of those listed investment companies, which total around $2.3 billion of funds under management. And one of those funds is WAM Microcap, which is approximately $350 million that we run. So we started the Microcap fund 5 years ago, and it's grown to that point since then. Obviously, been very happy with the returns over that period and delivering to shareholders. And much as Paul said earlier, our reasoning to start the Microcap fund was very simple, and effectively it was because we were seeing opportunities at that lower end of the market. Previously, we'd bought a number of those companies in WAM Capital, which is a very large fund, and because the weightings of those microcaps were very small in WAM Capital, they weren't really making a difference for the fund. So that was the reason to start up WAM Microcap. And it's been a very strong period, I guess, for microcap investing since that point in time. And what we generally find is that in terms of the research coverage, the knowledge of the companies that we see in that space, and also we have a lot of access to capital raisings or initial public offerings. So we do think there's quite a sweet spot for looking for companies around which are less than, say, 300 mil market cap, which is, I guess, the benchmark that we use. In terms of the benefits of investing in a listed investment company, look, there are positives, there are negatives, but the way we sort of look at it, which is the big positive, is once you raise capital in the market, it's fixed. Now, what that means is that when you have periods where it's very strong in the market, you're not getting inflows. And when it's periods of weakness, you're not getting outflows of people taking money away from you. And it's funny, we're seeing that at the moment where there's a lot of volatility. And so we're seeing a lot of our competitors, effectively fire sale some companies in the market, which is a great opportunity for us to act contrarian and actually buy stocks at a cheap valuation. So I'll leave it at that. And Paul, I'll pass it back to you.
Terrific. Thanks, Oscar. So you've already touched on this. A microcap company here in Australia is typically a company with a capitalisation below 300 million. I'm very keen to understand your investment selection criteria when buying these microcap companies.
So across Wilson Asset Management, across all the funds, we still have the same investment process. And effectively, how we look at companies is that we have around approximately 50% of the companies we look at are research driven, and the other 50% are what we call active or market driven. So if I start off with the research driven part of the portfolio, and this has largely been the driver for the fund over the last, say, 5 years. But effectively, we're looking for long-term investment ideas. Our general holding periods 3 to 5 years, and we're looking for a company where the estimated growth of the earnings is higher than the valuation that the company is trading on. We're looking for a very strong company within its chosen field of expertise or sector. And most importantly, we're looking for a very strong management team and board. Now, we won't invest in a company unless we see a catalyst. And a catalyst for us is, say, an earnings upgrade or a better than expected result. It might be an earnings accretive acquisition, or it might be a divestment. Now, in terms of the market-driven side of the portfolio, this is generally when we're making quick decisions, and we could hold companies for a period of a few days. We could hold it for a few weeks, a few months, and it's effectively any company that doesn't fit the research part of the portfolio. So this is where a lot of the initial public offerings or the capital raisings, this is where they're generally held within the portfolio. So, and again, like research, we need a catalyst. So that's consistent across all the Wilson Asset Management funds and, of course, the Microcap fund.
Fantastic. So look, 2021 was a strong year for microcap investing. What were the reasons why it was such a good year?
Yeah, thanks, Paul. As you said, it's been a very strong year on the back of very accommodative macroeconomic policies around the world and elevated levels of government spending on the back of coming out of the pandemic. So it's been a really good year for microcaps. And what we've seen has been companies that's seeing an increase in their earnings as well as an increase in valuation multiples. So there's a lot of risk tolerance in the last year. Now we've seen that change pretty drastically over the last couple of months, which has added a level of complexity to our stock picking process. But in terms of 2021 as a whole, it's actually been a very good year.
Terrific. So that's the natural next question. 2021 was a good year, and you've touched on this, Tobias. But what are some of the themes that you've identified that you need to be looking at the start of 2022?
Yeah, look, I think inflation is probably the big one everyone's talking about at the moment. And if we look at sort of the small and micro cap industrial companies that we look at, there's really been a sell-off since it started around mid-September. And a lot of that had to do with the resources sector doing very well. So other fund managers or retail investors were selling their industrial companies and buying resources companies. But then, of course, we've seen through November, December, January, inflationary expectations increase quite considerably, particularly in the United States. Now, in terms of how we look at it at the moment, currently there's 5 interest rate rises implied by consensus or analysts looking at the US from March to the end of the year. So we do think largely these inflationary expectations are in the market. We also do think that there is a number of temporary impacts that are causing the consumer price index or inflation to be higher. And they might include used cars or retail apparel or food. And we think that will come off as we sort of cycle over the larger inflation numbers that were printed last year. So in our view, we feel like it's in the market. We've gone through past periods and had a look at when we've seen rate rising cycles. And interestingly enough, for the most part, you do see a sell-off of, call it 10 to 15% early on. And then you do actually see quite a strong rally in the market since then. So 2016, 2006 are 2 periods in particular where we've seen that. But most importantly for us, and this is the key, the stocks that we invest in, which are largely a lot of companies exposed to the economy, are trading on valuations that are actually at 10-year lows. So we're actually very positive going into this reporting season and also over the next few months for the stocks that we look at.
Yeah, fascinating. Now, when we had this webinar 12 months ago, or roughly 12 months ago, you indicated that you were reducing your position to the technology stocks in the portfolio and the COVID winners, like the online retail stocks as an example, and you were moving more into the cyclical stocks. Now, that played out very well for you. Has your view changed on those sectors? I see on this slide here, the sell-off in the technology stocks. Is it overdone? Is that something that you are looking to reposition the portfolio towards?
Yeah, thank you. So our views haven't changed. In fact, we've become even more selective in terms of picking technology names particularly over the last 2 months. I think you can no longer rely on valuation multiple expansion as a catalyst to buy a stock. You can no longer rely on buying a basket of similar, companies in a similar theme. We have to be very stock specific. And once you see a chink in the armor, you have to, exit the position very quickly. We think that's going to continue over the next 12 months. So for us, there are definitely a lot more boxes that we need to tick before we get a stock into the portfolio. The investable universe has shrunk. We've, staying even further away from a lot of these high valuation businesses that's burning a lot of cash. But we are still seeing value in certain parts of the market, but it is getting tougher, but we've become more selective.
So, cyclical stocks would include those travel stocks, which were obviously particularly hard hit during the pandemic or have been hard hit. What's the portfolio positioning at the moment towards that sector?
Yeah, we got a high exposure there. So one of the largest positions in the portfolio is Tourism Holdings, which it's been there for some time now, which is effectively the largest camper van rental company in New Zealand, Australia, and the US. It's recently acquired its number 2 competitor, Apollo, which is based in Australia. So we do see that market changing, which will be very favourable for the company once borders do open up. We also have Experience Co, which is also a very large position, be a top 10 position. These guys run skydiving in Australia and also have a portfolio of tourism assets, and recently did an acquisition, which effectively my family's been using over summer last few months with these ropes courses across Australia, which have done very, very well. So those 2 stocks will be our 2 big holdings in travel, but I think that is a beaten up sector. We do think these companies will be stronger, much stronger than what they were prior to COVID. They might have lower revenues, but their cost bases have been structurally reset. So we're very confident on that sector.
And you mentioned earlier that the WAM Microcap portfolio is largely a portfolio of industrial microcaps. As I understand, in the microcap part of the market, the mining businesses did very well in 2021. So was that a drag on your portfolio returns? And how do you see the positioning of your portfolio going forward with respect to that?
Yeah, I mean, over the last 12 months, I mean, we're ecstatic, to be fair, in terms of how we performed, because resources within the small ordinaries index is approximately 25% of the index, and we don't really own any. And small resources have risen at just over 20% over that period, whereas sort of small industrials have been sort of relatively flat. So it has been a headwind. I think it will continue to be a headwind. There's no doubt that inflation makes resources a very attractive sector. However, we will say it's a very crowded trade from our peers. So, when as we've seen with resources, we've been in a 6-year bull market for resources. When things turn, they can turn very quickly. You could see that with iron ore just a few months ago. And I think it had the sharpest sell-off it's ever had. So I guess we're conscious it's a headwind, but we're backing our stock picking ability in industrials to get us over the line.
Now, it's not on this slide, but I noted in your last update that the WAM Microcap portfolio is quite overweight the telco sector. That seems to be a significant overweight position. Do you mind explaining the reasons why, and perhaps a couple of the positions that you've got that support your overweight in that sector?
Yeah, definitely. So we like the telco sectors, particularly on the small end, because it sort of strikes the right balance between growth, valuation, and certainty, given they provide telecommunication services. So on the growth side, it's coming from both organic growth, which is winning market share from the incumbents being Telstra, Optus, and TPG. But at the same time, those three large guys, they're restricted in terms of what they can acquire. So the second tier players are effectively consolidating the market. So that adds an added level of inorganic growth opportunity to many of these names. And on the valuation side, many of these companies are on actually pretty attractive valuations. Considering the growth actually looks pretty good over the next 3 to 5 years. So some of the companies we have in the portfolio includes TUA, which is Tuas Limited, which is a mobile disruptor in Singapore. We have Aussie Broadband, which is I think a household name these days. And we have Swoop, which is a fixed wireless business, and particularly in regional Australia.
Now, one area of the market that WAM Microcap is able to invest is in the pre-IPO market. Now, from your portfolio, the most notable example I could see of a pre-IPO investment that listed was Iris Energy. So I guess this question is twofold. Is this part of the market that you're being quite active in at the moment? And how lucrative is the return opportunity if you get these pre-IPO investments right?
Yeah, thank you. Very lucrative is the answer. So, we've been very active in the pre-IPO space for most part of the last year. In the last couple of months, given Christmas, New Year's, it's definitely slowed down in terms of sort of new opportunities coming across our desks. But we envisage that to ramp up, once the market settles down a little bit. Iris has been a phenomenal contributor to performance for WAM Microcap. When it listed on the NASDAQ, it's had a pretty volatile start to the listing, but I guess the advantage is we got in at a very low valuation, so we're still up a few times from our entry price. This is definitely an attractive space for us. It gives us an early look at some very exciting businesses that's deciding to do the pre-IPO route before they list on the IPO during the initial public offering. Another company which we saw in the papers today is Expansive. We got in really early. This is a carbon trading platform, and it looks like they're doing really well, and potentially looking to list towards the end of the year.
Well, 2021 was a big year. It was a big year for IPOs, capital raises, private equity interest in the micro-cap end of the market, takeovers. So again, I want to ask the question, you've mentioned you're quite active with the pre-IPOs. how busy a year was 2021 for you in these areas, these corporate actions, and how does 2022 look for you as well in this area?
Yeah, there's definitely been super active again in terms of corporate activities. We participated in a lot of capital raisings, both companies that we have that's looking to raise money to further their growth or acquire other companies, as well as new IPOs, new ideas that we use to replenish the portfolio of companies. In terms of takeovers, we had one of our larger positions, Virtus Health, receiving a takeover offer from a private equity group, which we've sold into. We envisage 2022 to be similar. There's a lot of private equity venture capital funds that's raised a lot of money that they're waiting, I guess, for the market to settle down before they start deploying that capital into the market. So, we think it's going to be a very active year again.
We love talking stocks, and this is probably what you enjoy talking about most as well. So I wouldn't mind perhaps looking at some of the more active positions in the portfolio, and you're both giving us a little bit of an explanation of the business and why you own the business. Could I perhaps start with Ardent Leisure, which I see is one of the big overweight positions in the portfolio?
Yeah, so we quite like Ardent. So, we think 75% of Ardent's intrinsic value is in the main event business, which is, a bowling centers business in the US. They're rolling out more bowling centers. The like-for-like sales looks really good. The margins look really good. And, the new management team that got installed about 5 years ago is doing a great job. So we think that growth will continue, particularly on the back of people coming, going out again post-COVID. The 25% of the intrinsic value of the business is in Dreamworld. Obviously they've had issues in the past, but we think with international tourism, hopefully on the short-term horizon, that's going to boost that part of the business, and there's going to be massive operating leverage in the Dreamworld business, which is effectively a duopoly in Queensland. So currently, when you're buying Ardent, you're not paying anything for the Dreamworld asset. So we think that's a huge margin of safety, and we think the business is very well positioned for growth over the next few years.
And you mentioned Tuas before. I hope I'm pronouncing that right. I was fascinated. Singaporean telco, I think you mentioned. Again, one of the big overweight positions in the portfolio. Could you just explain, who the business is and why you own it at this point in time?
Yeah, sure. So Tuas Limited was founded by David Teal, the founder of TPG Telecom. We really love founder-led businesses, given, they have skin in the game, they have aligned interest. And David Teal is probably the smartest telecommunication executive in Australia. So this was a business that he owns around 35% of this business. He's founded it. So they provide mobile services in Singapore, which, it's actually quite big. There's about 8 million handsets there. So it's not a small market. And they've been able to win market share at a very fast pace on the back of offering very extreme value to their customers. So the price of their mobile plans are typically 80 to 90% cheaper than the three incumbents, who can't compete with them because then they risk cannibalizing the profit of their existing customer base. So we feel like, they can continue that growth, and potentially, Singapore's a beachhead for many of the other Southeast Asian countries for Tuas to expand over time. So for us, Tuas is a market share story. We think that they're going to gain market share over the next few years, and it's going to continue to grow. And it's his baby, given, he stepped off TPG Telecom's board in the last year.
And just sticking with the telco theme and going a little bit off script here, but I think Aussie Broadband, you mentioned it before, but that's a name that's, I think, pretty well known to Australians. If you had said to me a few years ago, buy into a reseller of broadband services, I would have said to you, gee, I'm not sure about that. They obviously appear to have done a very good job. So what's sort of the thesis behind your holding in Aussie Broadband at the moment?
Yeah, so the seismic shift in the telco space over the last 10 years is the NBN. And so initially what you saw was, a lot of companies try to become, the new reseller of scale on the back of the NBN network. And Aussie Broadband has, come through, and they're now the leading provider of, I guess, telecommunication services to consumers. And their strategy, and this is founder-led business, their strategy is on customer service, and then on the service of their, on the service of the internet, so to speak. And what's happened during COVID, and because everyone had to work, at home, having the best internet service became paramount for a lot of people. And you know, they had a huge period of growth on the back of word of mouth and on the back of their service. So we think they can continue to gain market share, you know, winning it off the guys like Telstra and Optus, just by being the best service provider. So you know, Phil is the founder, is the CEO, is super impressive, and he's done a great job growing this business over the, you know, very short period of time.
Fabulous. If I can move on to Enero, which is obviously another very strong position in the portfolio. Would you mind explaining a little bit about that company and why you own it?
Yeah, so we've owned Enero since the launch of the Microcap Fund just over 5 years ago. And Enero is effectively the old Photon Group, which was a failed roll-up of advertising agencies prior to the GFC. It was effectively broke, and then they recapitalized the business to Enero. So effectively what the business is a series of a group of marketing or public relations agencies. It's a global business, has a very strong exposure to the United States. And it's really taken off over the share price has taken off and earnings over the last 2 years, which is largely driven by two businesses in the United States have a very strong exposure to the technology sector. And for a little company based in Australia, it's actually ranked, I think, the third best PR or public relations agency for the tech sector in the United States. So it's you know, which is a very high credential. Most importantly, valuation is very good. So it trades at a price earnings multiple valuation of 11 times. It's growing well over 20%, and most importantly, has zero debt and about $30 million of cash. So we think there's plenty of room for acquisitions for this one. So we quite like this one.
Yeah, one of the things that I'm finding really interesting about the chat about the companies that we've spoken about so far, Ardent, Tuas, and Enero, is that, you know, perhaps there's a little bit of a misconception here that these Australian small companies, these micro caps, are very domestic businesses. But from your explanation of each of the businesses, you know, these Australian companies appear to have quite substantial footholds in international markets. Is that a growing trend in the micro cap area of the market?
Yeah, I'd say, I mean, that's what we look for in stocks. Like, that's a very important characteristic for investing in microcaps, because a lot of the time you're thinking, we're seeing them at a very early stage, right? And there's a lot of larger funds out there, a lot bigger than us. And we think to ourselves, and we talk about this all the time, is this large fund manager going to buy this company, you know, if it does well, and say the market cap goes from $100 million to $200 million. So having offshore earnings and the ability to grow outside of Australian huge markets is massive. That's one of the, you know, we talk about this all the time. And, you know, and a lot of those stocks that are on that page, are international businesses. So that's definitely a key thing that we look for sure.
And Ridley's a company I think it's pretty well known to Australians, but perhaps just an explanation of the Ridley business and why you own Ridley.
Yeah, well, that's the exception to the rule. The offshore businesses, it's very much an Australian-owned business. But look, Ridley's been around forever.
Yeah.
And this is the opportunity we see the stock. If you have a look at the share price over the last 30 years, it's done nothing.
Yeah.
And it's been a pretty poor performer. Now, the catalyst for us to invest in the business, and this is a feed processing or manufacturing business for the agricultural industry.
Yep.
The main catalyst for us to buy the business was effectively a change in management. You got a new chairman, you got a new CEO. They're from Ingham's and did a very good job at turning that business around. Over the last 2 years, they've sold non-core assets or underperforming assets. Balance sheet again is very strong, close to net cash, plenty of ability with debt facilities to buy things. And they've taken costs out of the business. So, and we're starting to see the top line move as well. So we sort of look at it very similar to the Grain Corp, which is traded, which is a bigger company where it did not move out of a band for 30 years. And then suddenly it moved out of this trading band, and at Wooshka, it's up 50%. So that's what we're hoping with Ridley. Again, very cheap valuation, trades at 12 times earnings. We think it'll grow more than 25% this year. So very positive on the company.
And the last one, probably not so well known to us Melbourneites, but much better known, I think, in the northern states, particularly New South Wales, McGrath. I'm curious as to your position in McGrath and the outlook for the company.
Yeah, so McGrath is incredibly cheap. So effectively, it is a real estate agency in New South Wales. I think it's got a small exposure to Victoria, but growing. Yep. It was a horrific IPO. It listed about 3 or 4 years ago. But again, it's one of those companies, and we get this opportunity in microcaps a lot where it's just forgotten about. And effectively, I think the enterprise or the market capitalization of the business is about $70 million. They've got $30 million of cash, and their rental business, I think, is worth $40 or $50 million. So you're actually getting the real estate business, which is buying and selling property, for free at the moment. So we see a good opportunity. There's obviously a very strong property market, which is good. And also we see the potential for capital management. So as I said, very cheap company. I think it's on single digit, it'd be like 7 or 8 times earnings. So yeah, that's a great one in our sweet spot with microcaps.
Yeah, that pricks my attention a little bit. So if I could use the term a down and out company, just as a colloquial term. So how much time do you guys spend looking at these companies perhaps are a bit down and out? And, is it how big a risk is investing in those companies? Can it become a value trap?
It can, but it can also be very lucrative. I mean, if you look at our best investment, probably within the microcap fund, since we launched, it was City Chic, which was the old specialty fashion group. And one of the competitive advantages we see ourselves having with running the microcap, and Paul, you mentioned before, we're busy, we've run 4 funds, but we feel that's a competitive advantage because we see a lot of these companies that were big companies, one day, and they've had a very tough period and they fall in the microcap space, and then they get forgotten about. And specialty fashion was exactly that. It was a retailer, had too many brands. We kept seeing them every 6 months. It was every time we see them, it get worse. It get worse. And then I remember we saw them and they said, we're thinking about getting rid of the bad brands and just keeping City Chic. And that was at 20 cents a share. And we bought a small position in the microcap fund. This would have been the end of 2017. And they sold their bad brands. And, our competitors probably didn't even notice that, right? But we knew it. And we were like looking at this going, well, we've got this high growth business that's left. And we're actually getting paid because they've received cash from selling their old brands. We're actually getting paid just to invest in it. So it was beautiful. I've never seen an investment like it. But City Chic got to $6.70, I think it was, at its highs about 3 or 4 months ago. So, and every fund manager owns it. So I guess they're the best investments for us. Big company becomes a small company. People forget about it. They generally, it's a company that's been around a long time. They don't generally stay bad for a very long period unless something is materially wrong. So we're always sniffing around in those companies. We love those investments. And that, as I said, that's we feel is one of our competitive advantages.
Yeah, I think just to add to what Oscar was saying, a lot of these, it's based on a catalyst. So a lot of the times it's change in management, or change in board or new strategic shareholder. So that's a catalyst for us. We'll go and interview the management team to see whether the strategy's changed, their background, understand, where they've come from, how have they turned around other businesses. So it really helps us with our, looking at these businesses and sort of building that margin of safety into those investment decisions.
Yeah, I think this is fascinating because when I think about microcaps and I think about you constructing a portfolio, I'm thinking about you trying to identify these very small companies that are on this trajectory of growth. And I didn't think so much about companies potentially that did become a little bit down and out. And through the skill set of the whole team, that you had the opportunity potentially to look at these companies that were down and out, and if there was a catalyst. So obviously you guys see this as a very strong competitive advantage of investing in, of being a part of the WAM group.
Definitely. I mean, great example. I'll give you another example. I think this time last year, we talked about 7 West Media as one of our top picks. And this is a great example. The company's bombed out. Everyone goes, they've got a structurally declining television business and a newspaper business, right? But they've got this digital business within 7 West Media that's continually growing 20, 30% every year. And now all of a sudden, that business is probably about 40% of earnings. So the whole perception of that business can change. And suddenly maybe that becomes 60 or 70% of the business. And other investors are going, well, you know what, we might pay a high valuation for 7 West Media now. So that is one of the key things that we look at, particularly if you get an old business that's been around for a long time. It might have a small part of that business that's growing very strongly. And we're like, okay, maybe in 2 or 3 years' time, that tipping point will come when I guess how people will think of the business differently. If I look on that slide, I mean, Eniro is definitely an example of that. Experience Co is an example. Tourism Holdings is an example of that. Capital Health A lot of them, they were double the size a few years ago, and it fell by the wayside. So that's definitely something we identify with the companies we look at.
So we've spoken about quite a few of the winners in the portfolio of the overweight positions, but no doubt when you're running a micro cap portfolio, there's going to be the odd occasion where you're not getting one right. I'm curious to know whether over the last 12 months, there were or have been some mistakes, and if there were any lessons learned out of those mistakes.
Look, plenty. And I think one of the things, when you're a reasonable size fund like we are, if you get something wrong, often you can't get out of the company. So, I think a couple of these we're going to mention today, and we'd love to sell the companies, but we can't. So they're stuck in the portfolio. So that's one of the lessons you need to learn. It is high risk investing. There's no doubt about it. But look, I'll start off with one. So the first one was Propack. Propack is a packaging company, been around for a long time. As Paul said, sometimes you can get stuck in value traps. Big companies have become small companies. This is an example of one that went wrong. And we had all the right reasons to buy it. It was trading at a price earnings multiple, I think, of 8 times. New management team, which was the catalyst. They were taking out costs, and they were also, the balance sheet was very strong. So we thought they could acquire. Now, everything was on track. And then COVID hit the second time around September. Well, when probably Omicron hit, they've had a lot of staff absenteeism. But the other big one, which we probably didn't envisage, was the oil price through resin costs is a big part of their cost base now. And obviously oil prices have gone up a lot, and they haven't been able to pass that through to their customers. And I think the lesson for this stock, which we got wrong, is it just has no pricing power. So it's fine to go to invest in a company that's very cheap. That might be cyclically hurt. That's fine, but they've got to have pricing power, and they've got to lead the industry. And that was the mistake we made on Propack.
So we're coming towards the end of today's webinar, but the $1 million question, obviously it's been a great couple of years to be an investor, and particularly in the micro cap space. How are you seeing the market for 2022?
Yeah, I think it'll be a tougher market. There's no doubt about it. And we've come off a very good period over the last 2 or 3 years. And, we've just had a period now where the market on small cap industrial companies have fallen sort of 15%. Micro caps haven't been immune to that. I mean, we've had a tough January as well. We're happy with how we went, but, we were definitely clearly, delivered negative performance over January. But I think, we look at it, last 2020 following COVID, and 2021 has been a huge period of capital raisings, initial public offerings, and so forth. That will really slow down in 2022, particularly given the start that we've had. So that has been certainly been a free kick for us in most instances. So, you could argue you probably won't get that benefit to the same extent. Resources, we think will continue to be strong, given inflationary concerns. Now, as I said, though, that's a very crowded trade. So that could come off, and we could be a big beneficiary of that. But put it all together, I think if we look at, and we talked about a few stocks today, the valuation of our portfolio right now is probably the lowest it's been for some time. We really do think we're in a lot of sectors such as travel and retail, and that have been really hit hard through COVID, Omicron in particular, but are also, more importantly, well positioned in an inflationary environment. We do think earnings will come through, and we do actually think we're coming towards the tail end, touch wood, of Omicron. And so hopefully we should get this, pent up demand coming through in the next sort of 6 months. And people have forgotten, it was a highly disrupted year, really from March last year up until now, for a lot of these companies. So they will be cycling over quite, easy periods. So look, for us, we're stock pickers. Our investment process has proved to work through all markets, really, since our inception of Wilson Asset Management. So we're confident in the portfolio and our ability to pick stocks, but we do think it'll be a tougher market, no doubt about it. So yeah, I'll leave it at that.
Terrific. Oscar, Tobias, thank you for your generosity of time, not just today, but always being available to us when we've got any questions. On behalf of the GFM team and on behalf of the GFM clients, thank you for your outstanding results since our clients have been investors. We wish you the very best of luck in 2022, and I look forward to catching up. Thanks, guys.
Thank you very
Thanks,
much.
guys.
Cheers.
Appreciate the support.
Take care.